Hello and welcome to a brand new show of Market Makers. My guest on the show today is someone who I've always maintained is indeed one of the best stock pickers on D Street. He's got a knack of identifying multi-baggers and is certainly running one of the most best performing India dedicated funds. Akash Prakash of Amansa Capital. Akash, what a delight to have you back on ET Now. Thank you for joining us.
Thank you for inviting me. Thank you.
Akash, let's start with the moot point. What do you make of the cabinet formation? There are some bizarre combinations. Arun Jaitley's got both defense and finance. Telecom and IB have got to Ravi Shankar Prasad. How do you think markets would react to it?
I think, there's some good and some bad. I think obviously, as you said, some of the combinations don't, on face value, seem to make sense. I think Mr. Jaitley obviously is very, very qualified and one of the best ministers. But to have both defense and finance seems too much on the plate for anyone to handle. So probably it's a stopgap arrangement. And I think the cabinet will be expanded further probably in the next couple of months. I think so. That was so there's a little bit of confusion around there. How do you have certain unusual combinations? Second, I think the market was expecting some technocrats or industry experts to be a part of the cabinet. That hasn't happened as well. So maybe again that may be something which will happen going forward. But I think the positives are the fact that no one over the age of 75. He's clearly gone against dynastic politics. No one from the BJP at least with a family dynasty type of situation. They've gone for some young people. So and clearly, I think it shows that Mr. Modi is clearly in charge because of the way that all the allies, irrespective of what they said publicly before the cabinet formation, all the allies have got one or two positions only each. So I think we should let's wait for a couple of months. I think the composition hopefully should work, and I think also depends on Mr. Modi. Clearly, he's going to be driving it. So hopefully this will be an effective team that is put together.
Akash, what the NDA government has inherited, they have inherited a weak economy, poor investor sentiment, they have limited fiscal ammunition. How do you think the NDA government will be able to fix things in a hurry?
Well, I don't think they're going to be able to fix things in a hurry, frankly. I think what reality is that I think they do have a honeymoon period of probably 6 to 9 months. I think investors recognize that this is that the economy is in a funk. You don't drop from 9.5%, 10% GDP growth to 4.5% unless something is seriously wrong. So obviously, I don't think investors expect an immediate, any type of immediate magic wand or panacea. But I think what they'll have to, the first step is in the budget. You'll have to see some attempts to rationalize expenditure, boost revenues. I think you'll start seeing attempts to get projects moving, attempts to get GSTs back on track. So I think it's a series of small steps which will give confidence to investors that this government's top priority is getting the economy back on track and controlling inflation. So as I said, I don't think anyone expects the economy to get back to 7%, 8% growth in the next 6 to 9 months. This is a 12, 18, 24-month recovery process. But it's a series of small steps which, in the market, the discounting mechanism. So the market will obviously move up in advance of this. So the market will look for signals like, what the budget, for example, what they do on projects, what they do on GST, what they do to better target subsidies, what they do on the retrospective tax amendments, stuff like that. So he has time. As long as he moves in the right direction and slowly rebuilds confidence, I think the market will do fine.
So Akash, the new government will have little breathing space. They will have to come out with the budget soon. Do you think budget will be the first big message of the NDA government about their grand plans and how they plan to really lift the economy?
Well, I think it's important because it will set a direction and tone, right? For example, it will give a sense of what they want to do how will they boost revenue? Clearly we need to improve revenues. Are we going to do it through bringing in GST and the direct tax code? Are we doing it through some other, through privatization or selling PSUs? Will it be a voluntary disclosure scheme as some people talk about? So clearly it will set a direction of how they're going to raise revenue and what are they going to do on the expenditure side. Because there's a popular perception that while we do need to have a significant social social spending on education, health, poverty alleviation, there's a common perception that most of our spending in India is either badly targeted or, or just has tremendous leakages. So I think people want to see both. How do they get revenue going beyond just economic growth? I mean, how do you boost revenue, which I think will revolve with some type of tax reform. And they want to see better targeting of expenditure. So I think so the budget will give you a good signal on both, as well as their, the general orientation to economic policy. Do they reduce government involvement in sectors, stuff like that. So the budget document will be important because it will set a tone and direction for the next 5 years. Do they, will they adopt the FRBM fiscal deficit targets of 3% of GDP? Is that a target they're going to accept? Do they come clean on the fiscal numbers? Again, popular perception is the fiscal situation is far worse than is shown in apparently the numbers in terms of expenditure has been postponed and deferred and stuff like that. So I would hope they come clean on the numbers, say this is the real situation. This is what we target to bring the fiscal deficit down to over the next 3 to 4 years, and this is how we'll do it on the revenue side, and this is what we'll do to improve expenditure.
Akash, it's been a one-way street for Dalal Street. Just about everything and anything from the old economy basket is up 40 to 50%. In the short term, do you think prices are running way ahead of themselves and prices that need to come down before value emerges?
Yeah, I think you will have a consolidation phase in the market. I think the market is overbought in my view. I think you will see a cooling off. You will see a correction, or probably 10%, probably 5-7%. With some of the mid caps which are up 70, 80, 100%, probably coming off 20, 30%. There is so a short-term correction I think will happen, which I think is healthy for the market. But I think every correction now is a buying opportunity. Personally, I am quite optimistic. I think that this new government has a real opportunity for India to break out in the minds of investors, both globally and domestically. So my view remains that yes, of course you'll see corrections. The market is ahead of itself. But the corrections will be short, sharp, and swift, and I think those corrections will be buying opportunities. And I'd also say that I don't expect this market to get to a level where it looked cheap on short-term numbers, because I think the market will look through a valley of earnings, as I've written about some time ago. You're not going to see this market trading at 10, 12 times. That's not going to happen. The market is already starting to discount that you're going to get to a situation where economic growth in India is going to accelerate. If economic growth accelerates, earnings growth will accelerate, and people are starting to build that into their numbers. So if you're going to wait here saying that no, I want the markets to come down so that it's trading at 12, 13 times March 15 earnings, I don't think that's going to happen. The market's at 16 and a half times. It'll have these short, sharp, swift corrections, but it's not going to come down to a level, in my opinion, of trading at 12, 13 times and be obviously cheap. That's not going to happen. That train has already left the station. The market already implicitly discounting the fact that this government means business and that economic growth is on an upward trajectory.
Your decision to buy into cyclicals a quarter ago was a great one. You bought into Ashok Leyland, Thermax, Crompton. Do you think easy money has been made in cyclicals?
The easy money has been made in the sense that, the first move, which has gone from, you would argue, deep undervaluation on a normalized earnings basis to probably somewhere near, more realistic valuation, that move is over. But is there still upside in those names? I think there will be if the economy recovers as strongly as I think it will. So, but yes, the risk reward obviously is no longer as favorable now as it was, 6-9 months ago, because some of these stocks are up. I think in case of Leyland and Crompton, they've actually doubled. So these are obviously the easy money is over here.
So what do you like in cyclicals now? Have you bought anything new? Have you added new ideas?
No, I think what we have added is some private sector financials. We've added one private sector bank which we're still buying, so I'm not in a position to disclose the name of that right now. But I think one of the easier ways to play in economic recovery is the financials. I think the top tier private sector banks are not that cheap anymore. They're probably 2 to 3 times price to book. But there are some smaller private owned, not private sector, older generation private banks, which are still trading at 1.4, 1.5 price to book, if not slightly lower. And I think, they will do very well over the next 2 to 3 years if economic growth comes back and as the NPA cycle starts moderating. And they tend to have, these guys who we're looking at have high levels of capital adequacy. And one of the theses we also have is that the public sector banking system is massively capital short. So if any institution in India in the financial services space if it's well capitalized, it will have a real strong growth opportunity, because the public sector banking system is capital short, and that's not going to change in a hurry.
You have a strong preference towards regional banks and regional NBFCs. You told me in the past that you like Cholamandalam, you and Federal Bank.
Yes.
What is so special about Federal Bank? Because some would argue that if gold prices they come down, the balance sheet of Federal Bank could suffer.
Well, to a certain extent, if you look at the last 12 months, they've already slowed down the gold loan book quite significantly. They've not grown it much at all. So I think, I think to a certain extent they've already, seasoned that portfolio, for lack of a better word. Also, the banks are very well positioned. They don't have any, as you know, gold loans have no capital charge at all. So it's a very profitable product for the banks. It's a secured product. The NPA performance is actually very good across the banking system for gold secured loans secured by gold. Also, while prices are down, I think their loan to LTVs are not more than 65-70% in most cases for the banks when they lend to against gold. So I think there is no smoking gun on the gold loan portfolio for Federal Bank. I think they had very strong growth. That growth last 12 months, they've not grown the book much at all. The portfolio has seasoned. I think whatever, if any, excesses they had on the LTV side has been ironed out. So I think from now, you will start seeing gold loans again growing for Federal. I think why we like Federal, I think we think the management is very good. I think Shyam, has a very good background and pedigree. I think he's done a good job the last 3 years he's been there. He seems very committed to building out the bank and building an organization. The bank is cheap. It was when we bought it trading at less than book. It's very well capitalized, 13-14% capital adequacy. Most of the non-performing loan issues are behind them. The bulk of their restructured book is Air India and Kerala State Electricity Board stuff, which we think will not go permanently bad. They will get the money back. And whatever other pain they needed to take on the corporate book, I think has by and large been taken. Their SME and agricultural loan sides are both doing very well. Consumer loans also doing very well. So they have three engines of growth: corporate, SME, and retail. Retail and SME are doing very well, growing at 20-25%, very stable asset quality. Corporate loan book has been challenged. They've had no growth last 12 months as they've kind of got rid of these consortium loans, and that's where they've had the NPA problems. I think they're near the end of that. So, you are buying it at less than book. What we think longer term is a 1.3, 1.4 ROA type of organization, type of loan, profitability profile. Should deliver, 15-16% ROE, less than book, good management, well run, independent board. So, and large cap, reasonably large cap liquid stock. So it made a lot of sense to us. And we did a lot of work on Shyam, and he has a very good reputation in the banking circles. We've yet to find one person who thinks negatively of Shyam.
Akash, historically, you've always shied away from buying into PSU stocks. You've always maintained that, look, we don't like the PSU culture. But historically, the NDA regime is always a strong regime for PSU companies. The NDA regime has always given PSU managers a greater elbow room. Also, at a time when corporate India has got a broken down balance sheet, PSUs currently are cash rich. Is it time to revisit PSUs?
Yeah, first it's incorrect to say we never buy PSUs. When my old Morgan Stanley did, we were very massive holders of BHEL and Container Corporation, and we own more than 10-15% of both those companies. So I have bought PSUs historically. I think the last 4-5 years we haven't, because under the previous regime, I think there was a sense that the PSUs were getting stepmotherly treatment and were, and didn't have enough operational freedom. I think if under the new government, under the NDA, if they genuinely give operational autonomy to the public sector entities, genuinely empower the CEOs and reduce interference, then there could be an opportunity there, because you're right, PSUs are by and large have been trade cheaper than the private sector counterparts, but they have scale, they have size, they have balance sheets, they have decent accounting. I think the issue has always been that under the previous regime, there was a sense that these organizations are not being run for purely commercial interests. So there were a lot of other interests beyond pure profitability, based on which they were being, their numbers or they were taking decisions. If they become again more commercially oriented, I think there could be a real opportunity in the PSUs, but we have to wait and see. I don't think you can say yet with any level of certainty that the regime has definitely changed towards PSUs and they have a lot more autonomy and there is a lot more focus on profitability and shareholder returns compared to the UPA regime. I think it's too early to make that statement. If we do see it moving in that direction, then I would definitely look at PSUs, because you're right, they're large, they're well run. And nothing against PSU. I mean, my father used to work in State Bank of India, so I think PSUs have very good people. I think the problem has been the incentive structure and the way they're managed has been suboptimal. I don't think it's a problem of people. I think it's a problem of governance, a problem of incentives systems, a problem of political interference. If you can solve the governance and incentive system and political interference problem, PSUs have very good people. They'll be good investments. I think the jury is still out. It's too early to say whether those governance issues have been solved. If they have been solved, I would definitely look at PSUs.
Akash, assuming that we are staring at a new economic regime for India, do you think a basic portfolio approach should change? Because up until now, those who bought into exporters, be it IT and pharma and some quality names, they've really hit the jackpot.
Yeah, no, I think, we've never played these sector themes things, Nikunj, we run a very bottom-up stock-specific portfolio. We don't run thematics and we don't look at sector rotation and stuff like that. So I think but the reality is obviously that if you believe that India is getting back to 7-8% economic growth, 7% at least, which I do believe it will come back to in the next 12-18 months, I think there is a huge delta there from 4.5 to 7.5% GDP growth. There are many domestically oriented businesses which have gone through a really horrible last 3-4 years in terms of order books, margins, negative operating leverage, rising interest costs, etc., negative cash flows, etc. Obviously, if the economy were to revive and recover, the delta will be maximum in those areas and sectors, right? So capital goods, domestic banks, things which have significant domestic economic sensitivity. Obviously, the delta will be greater there, and those stocks and sectors had done very poorly till in the last 3 or 4 years, forget the last 2 months. So you will see, and those stocks were and sectors were very underowned till recently. So you will see people flocking there and taking those stocks up, which is what you've seen. But I think you have to make a balance and see what are you paying and look at what is the earnings power of these companies in a normal economic environment. So, I wouldn't just blindly buy economically sensitive stocks irrespective of what the price they're trading at. You've got to look at what is the earnings power of these businesses in a more normal economic scenario and what they're trading at on that basis. If those stocks are expensive, then you shouldn't buy them. And I think there will be a time, if the sector rotation continues in the violent form that it has in the last 1 month, there will be a time when you start seeing real opportunity coming again in the so-called more defensive sectors of IT, pharma and consumer, because those stocks are derating. Already in IT, for example, you're seeing some mid-caps trading at 10, 11 times. And I don't think rupee goes to 55. I'm in the camp that rupee remains around 60, give or take 1-2 rupees here or there. So, I think you'll have a situation where you'll start finding very attractive valuations available in the more defensive sectors again. So this sector rotation will continue for some time. I think at some stage it will present an opportunity because it will get extreme, and you'll start wondering, why should I be paying 15-20 times normalized earnings for some economically sensitive stock when I can buy an IT or a pharma stock at 20 or a consumer stock at 10, 12, 15 times. So I think you look at individual companies and individual earnings profile and the core earnings power of individual companies and see what you're paying. I don't think you can we don't make a blanket argument saying you buy defensives or buy cyclicals irrespective of valuation.
So let's stick to your style, which is stock picking. When I looked at the BSE bulk data, I was surprised when I saw Amansa's bought into SKS Microfinance. Why do you like that business?
Yeah. You're asking why we bought into SKS? No, I think, To give a short answer, I think that it is an organization which is through the worst of its regulatory issues. I think I know the microfinance bill has not yet been passed, but I think it's stuck not for economic reasons, it's stuck on jurisdiction issues in terms of how many things will the RBI actually govern or regulate. I think the RBI is, I think, quite clear. They have laid down guidelines of what is the spread a microfinance institution can charge, what is the maximum lending rate, what is the amount of money they can give, etc., etc. And I think they've created a new category of NBFCs called NBFC/MFI. So I think the regulatory environment is far clearer for these microfinance companies now than they were. I think they have a genuinely defendable business model in the sense that I don't think the banks can do what these guys do in terms of the granular lending they do at a very small ticket size, self-help groups, very rural effectively, and also I think the fact that CIBIL now is getting involved in giving credit scores and credit history for people taking money from the MFIs as well has significantly improved the control over the business. In the sense, the biggest concern in the past used to be that someone would take money from 10 different MFIs and be massively over leveraged and no one would know. I think the sharing of data through CIBIL is now far better. So the ability to take out or avoid making loans to people who already have too much exposure, too much money taken from MFIs has improved significantly. I think the access to credit or credit lines from the banking system is now clear and open. I think the loans they originate, are clear priority sector capable or priority sector eligible, which is again very valuable. So I think these are organizations which will generate 25% plus ROE type of return profiles, will have very strong growth over the next 3 to 4 years. And if you take into account the QIP, it's not cheap, but it's not that expensive given what we think the ROA and ROE profile of the organization is. So our basic bet was that the worst of the regulatory environment is over. You have regulatory certainty now by and large. It's a good business model. It can grow aggressively and scale up over the next 3 to 4 years. The quality of the control systems and processes improved significantly in the last 2-3 years as they've downsized and rebuilt the business. And it's an area which the banks can't attack. I mean, the banks will not be able to get into the space, so their profit pool here is quite protected. I mean, I can go into a lot more detail, but this is a short summary of why we think it's a good investment.
It's absolutely fascinating to hear that the kind of homework you do when you make an investment. Akash, so let me summarize our today's interaction. Your view is that a new bull market has started. In the short term, there could be hiccups, but an average Indian should now participate, and it is time to really change asset allocation?
Yeah, I think so. I think the bull market actually began in September of last year. As I said, the market's already up about 30% odd in dollars from that point in time. I think that the one thing people tell me is that all Indians are bullish globally. I mean, that may be partly true, but I think the clear fact is the Westerners are not yet caught on to this in the sense that when we talk to it's very early, but when we talk to limited people we talk to internationally, we don't get a sense that people have understood the potential significance of this change in government and that this is a real change in direction of economic policy in India. A first government which is right of center economically, a government which is far more pro-business, openly pro-business than the previous government. I don't think the foreigners have yet fully understood this. So it's not true that everyone all over the world is wildly bullish on India yet. So I think it's an opportunity for domestic investors to get they should use every correction, and there'll be many corrections, and I said there'll be short, there'll be sharp, there'll be swift. That you should use those corrections to put money into equities. I think domestic Indian investors are massively underweight equities, and they should correct that as soon as they can. Use every correction, in my opinion, to buy, unless you feel that Mr. Modi will not be able to deliver anything, and this is another case of disappointment, that he's got this mandate but does nothing with it, and that they do nothing to improve the economic outlook for India. If you believe that Mr. Modi will do nothing and spoil this opportunity given to him, this mandate given to him, then obviously you should not be investing in equities. If you believe like we do that this is a real mandate given to him and he will use it hopefully, and he delivers even 50% of what people think he will, I think you should be deploying money into equities in every correction.
Akash, what a pleasure and delight to have you back on ET Now, and certainly look forward to seeing much more of you. Thank you for your time.
Thanks, Nikush. Take care.